Assumable mortgages are touted as an amazing dang thing.
Wow!
Guess what? There is a reason I have this bugger right beside me. I'm gonna show you the numbers so you can decide whether it actually will work for you or it's too good to be true. Hi there. I'm Ella Gurfinkel, Senior Loan Officer with Team Ella at Fairway Independent Mortgage, and today we're going to look at, literally, not just talk about, but we're going to look at the numbers behind the assumable mortgages. Because yes, it sounds freaking amazing when in today's rate environment, when we're talking 6s, 7s, whatever the rates are today, and the assumable mortgage where you can take it over from the seller at 3%. Yes, I'm using 3% as an example because some will be at 2.5, some will be at 3, 3.5, 4, whatever, doesn't matter. The bottom line is, how does an assumable mortgage actually work for you, the buyer? Because the seller already got it. The seller, the property owner, they already have their mortgage at that rate. How do you, my friends, get to take advantage, hopefully, of the said assumable mortgage? Here we go. I'm gonna use round numbers so the math is super easy for everyone. Let's say you're looking at buying a house for around 100K. There you have it. And the seller's balance of the mortgage is 50,000 at, let's say, 3%. How does it work in this scenario? What do you need to consider to actually make it work for you? So let's say you can, in fact, qualify to take over the 50K. The real life numbers notwithstanding, but let's say that is the case. Now here's my question. There is a $50,000 difference between the 50 that the seller owes and the 50 that somehow needs to be made up. You, my friends, are responsible for coming up with that 50K. Let's say we're talking about an FHA loan because only FHA and VA loans are assumable and we're focusing on FHA only today. So FHA requires 3.5% down payment. Number-wise, it equals to $3,500 based on the 100,000 sales price. That's if you were buying the house at this price with this down payment and getting a whole new mortgage. But you have to pay the seller $50K because you're taking over the 50 that they owe. And you only have $3,500 that is required for a minimum down payment. Simple math, that leaves about $46,500 that you need to come up with. Now, here is the biggest issue that I see with most assumptions, and I'll talk about the mechanics of the assumptions in a minute, but here is the biggest issue. Unless you have a chunk of money laying around to make up the difference, you need to finance this somehow, right? And here is the rub. To finance the difference, you need to get another loan. That loan is called a second mortgage or a HELOC. Most seconds and HELOCs only go up to 90% of value of the home. So if the home is 100,000, 90% of 100,000 is $90,000. That leaves $10,000 out. You only have $3,500. You're still short $6,500. How are you going to come up with that? And this is based on a 100K example. Now think about a purchase price of $300,000, $400,000, $500,000, $600,000. That gap gets bigger and bigger with every pricing tier you look at. And no less important, the seconds and HELOCs are tougher to qualify for, require higher credit scores than normal FHA would. So back to how you're making up the gap. Do you qualify for the second or the HELOC? You still have to pay the seller for the difference. Taking over their mortgage is not enough. That's only one part of the issue, but wait, there's more. If you think that I, as a mortgage lender, or any other mortgage lender you may be tapping for this, or a banker, or a broker, can actually assist you. Let's say you solved the money problem, and you've reached out to a mortgage professional to assist you with the assumption piece. The assumption can only be processed, i.e. done, by the lender who the seller is making their payments to on their mortgage. So you have to go directly to them, essentially without any help. That process, on the outside, best case scenario, may take about 2 months. I've heard of it taking as long as 6 months, depending on who that mortgage company is. Ask yourself if you want to be put through the ringer for 2 to 6 months. It's like being left up a creek without a paddle as far as I'm concerned. But even more important, how are you going to come up with a gap? Like I said, multiply this by 3 for $300,000 transaction, and that's almost $20K you're looking at out of pocket, even if you qualify for a second-hand HELOC. But wait, the second or a HELOC, those interest rates are going to be in the 9+ range. So you're looking at 2 payments. One of them at the coveted 3%, the other at a pretty steep 9 or worse, meaning higher. So you really have to look at the bigger picture, what your total payment is going to be, and maybe you're just better off doing a normal standard purchase FHA, that 3% be damned, putting down 3.5% and calling it good. Because honestly, if I were the seller and you told me that the whole thing is going to take, 2 to 6 months, I would probably tell you to go find somebody else. Because most sellers I know, they want to sell and they want to sell now. And they want their money so they can move on with their life, use the money for a down payment on another property, or whatever the purpose is. Nobody in their right mind should have to wait for 2 to 6 months for the assumption to happen. In the meanwhile, you still have to qualify for that second or HELOC for the difference and come up with a chunk of change out of pocket. Got questions? Comment below, and I'll see you in the next one.